Okay, so look, I'm going to be walking through examples of these calculations. I want to just point out that we're going to be using the exact same transactions, okay, for all the different methods. And you're going to see that they're going to result in different cost of goods sold, different inventory balances. Okay, just the only thing we're changing is the method of calculating cost of goods sold. Okay. The other thing to keep in mind is that the revenue side, because you can see here we're doing sales and purchase transactions. The revenue side is separate from this. Okay, the revenue is dependent on what we're selling to our customers for. So that is kind of independent of this calculation. This is just how we're calculating cost of goods sold. Okay, so we're not given enough information to do like the full uh, journal entry for the sales transaction because we would need to know what we sold it for, right? We're only tracking right now what we're purchasing it for, or when we sell items, okay, what we're going to cost it. Okay, so let's do the first one. So the first one, we're going to use specific identification. Okay, so uh, we bought 4 units. Okay, so you can see here, we have, I guess, let's point out, we have a starting balance. So we have 2 units. The unit cost is 350, so the total value is 700. Okay, and of course, the math is 2 units times $350. And again, these are dollar amounts, so maybe I'll make that clear. This is just, I'm going to do an example, and then we're going to do like an actual problem. You guys will do that. Okay, so I'm just going to, yeah, this is not there. I'm just going to do this on the board quickly, and then we're going to do a problem together. Okay, so you bought 4 units, so the total cost is 4 times 365. So this is the amount I'm going to put in a journal entry, right? A purchase transaction. So we're going to debit 14,600, 14,600 credit, and we're going to get inventory here. Inventory. This is a purchase transaction. The costing method is not factoring into here, okay? The costing method only has to do with calculating cost of goods sold. The purchase transaction is straightforward. We just see how many units we bought, what the unit cost is, and that's what we're adding to inventory, okay? And I don't know, we can just do accounts payable, whatever, however we paid for it. Okay, so now what do we have in inventory? We have 2 units at 350, and then we have 4 units at 365. So this times this. So the total value of my inventory, again, these are all dollar amounts. Okay. So everyone see where I got this? Everyone's following? We have kind of like 2 layers of inventory now at these 2 different costs. Okay. So now is when the magic happens. We have a sales transaction. We're going to need cost of goods sold. So we're going to not use this section. You can see is for purchases. This section is for cost of goods sold. So we're going to be using this middle because it's a sales transaction. So we're selling 4. So I don't know. This can be, since we're able to track these 6 individually, there's 6 units here total. Maybe I'm selling 1 unit from this 350 and 3 units from the 365. Okay, this is one possibility. So it could be that our cost of goods sold. Let's just complete this assumption. Okay, so this 1,445, this would be used in my journal entry 1445, 1445, and so this is inventory. Sorry, cost of goods sold, inventory. So let me just keep a T account going here. In the T account, the thing it's missing is that it does not have any of the quantities. It's just going to be tracking the dollar amount totals. The extra advantage or why I have this table here is that I'm tracking the quantities and their respective unit prices. That's why we need this extra kind of information in the table here. Okay, but just for completeness or to show you the difference, so we had a starting balance of 700. Remember this? We had a purchase transaction right here, 1460, and now we have this sales transaction. So we have a credit. Okay, so as of now, if I were to just stop my transactions here, minus this. So let's just see what happens in our table. Okay, so I should expect to see after this transaction a value in my inventory 715. So let's just verify that. Okay, so I've sold 4 units. They were of this kind of mix, right? So how many units of this 350 do I have? 1, right? So 1 at 350. And then how many of these 365 units? Also 1. So if I add these up, it does reconcile with my T account, right? So again, this table here is just more detail of my inventory, broken out by units and unit price. Okay, but the totals will reconcile with my T account because I'm tracking just like the totals in the T account. Okay, so they should always be matching up. Okay, so let's do the next one. So now we bought 12 units at 3. And again, this I could have done 2 and 2, right? And that would have changed the situation. See, now it's 1,430. If I sold this, I would have 0 of these and 2 of these. Okay, so you can see here it would have changed my cost of goods sold, right? So then it would have changed this to 1460, 1460, and then this would have been 1460, and it would have been or 1430. Okay, so now you can see this 730 and this are also reconciled. Okay, so okay, so now let's just I guess let's just go with this. Let's say this was our specific identification. We were able to know exactly which 4 were sold. Okay, so now we're buying 12 more. So uh, the total value of this purchase transaction is this. So again, we would kind of have the same journal entry here, and the value, I could just kind of do a cell reference. Okay, so now 4, 6, 5, this. Okay, so that's the debit to inventory. And then in my detail, okay, I have 2 units of 365 and then 12 units at 380. So total of 14 units. 14 units and the total value is 5,290. Okay, and then I sold 10 units. Okay, so now again, we have some, since we're using specific identification, we're going to have to know exactly how much of each one. So maybe we sold 1 of the 365 and then 9 of the other one. And again, I know this because I'm tracking each unit individually. So I know where it came from, what bucket. Okay, this could have been 2 and 7 or 2 and 8, whatever it is. Or it could have been 0 and 10. Okay, so since we can track each one individually, we know what the distribution is. So I don't know, let's just assume 1 and 9. Okay, so the cost of goods sold is 3785. Cost of goods sold, inventory. Okay, and then I have debit, sorry, credit, inventory. And then let's just do a final, what is my ending inventory balance? I have one of these 365 units left because I had two and I just sold one. And I have 12 minus 9, which is 3 with the 380 ones. So my total value of inventory, okay, 1505. So let's just make sure that that's the case. So I had this balance plus this debit minus this. So yes, it does reconcile. Okay. So again, all this whole exercise here is really to be able to calculate this and this. And once we calculate this and this, it's going to kind of affect my inventory balance because again, these two are related, right? Where from this inventory, we took some units out and whatever is left over is going to be my ending inventory. So whatever method we use for this, it's going to directly impact the ending inventory after the transaction, the value of it. Okay. All right. So now let's look at FIFO. Okay. So um, same purchase transaction, nothing different. Purchase transactions again are totally unaffected by our inventory costing method. So it's going to be this exact same journal entry. Okay, so the first transaction is the same. Now we sold 4. Now okay, so let's just make sure we're clear. 2 units at 350 was our starting balance. Now we have 4 units at 365. Okay, so we're selling 4 units. So again, we're now moving to this section because it's a cost of goods sold calculation. First in, first out. We're going to start with the oldest units, this oldest layer. Okay, we're going to take as many units as we can out of this. So we have 4 total that we sold. This layer only has 2, but we're just going to take all of them. We're going to cost those first. So 2 at 350. And then however more units we need, we're going to take from the next oldest layer. So since we only have 2, we're going to take 2 more from here. 2 at 365. Okay? So this is our cost of goods sold using FIFO. I kind of inadvertently used FIFO here too, okay? I didn't mean to. So kind of ignore that. Ignore this. It's actually this, the numbers are the same. You'll see the difference when we do the last sales transaction though. Okay, so what do we have left? We have 2 units at 365. Because we got rid of this layer. This is all sold. These are all gone. So we only have these 2 units left. Okay, so then we buy 12 more. And again, the purchase transactions are all the same. So this transaction here is the exact same in both scenarios. Okay, and now we're going to, okay, so our ending inventory, again, we have 2 units at 365 that are carrying over. And then we have 12 more units at 380. Okay, so now we're going to sell 10 units, okay? So again, we're going to start at the back. These are the oldest ones. We're going to expense those 2. And then we're going to move on. How many more units do we need from here if we're selling 10 total? 8 more, exactly. So 8 units. So we're 365. These are 380. Okay, so what do we have left over? Well, we have 0 units at 365. And we have 4 units at 380. Okay, so we can see we have different ending inventory balances, right? 1505 with specific identification, which is arbitrary. We were just kind of randomly picking units here. Okay, this one is different though, just by changing the method. Okay, and then let's just do LIFO. So I'm not going to do this. I'm just going to kind of put in the values because I think we've seen it now a couple times. Okay, so that we're selling 4 units are sold. Okay, so now instead of starting at the back like we did LIFO, we're going to start at the front. So we're going to cost these 4 units first. Okay, so our cost of goods sold is going to be 4 units at 365 for 1,460. And if you remember back under FIFO, we had 1,430. So we have a different cost of goods sold just by changing the method. We're still selling 4 units. We're just now using LIFO instead of FIFO. Okay, so then we would have, whatever, cost of goods sold this, but instead of 1430, it'd be 1460. Okay, and then we bought 12 more. So again, what do we have left? We have this 350. Basically, we still have our starting inventory. It's the same inventory and the same inventory cost. Okay, because again, the newest stuff that came in, we sold that first. And then here, after this purchase, we have 2 at 350, and then 12 at 380. And then finally, this 10 units sold. We're gonna again start at this layer. Okay, so we're gonna sell 10 units out of here. So that again, we'll keep this 350 layer is still lingering. This is what I'm saying. This thing can just hang out for a long time. Oops, sorry. Okay, so in all the cases, we have 4 units left. 4, 4, 4. Same number of units, but different value because we've been costing them differently. This one has 1505. This one is 1520. This one is 1460. Everyone see that? Everyone agrees? Same number of units, but the balance sheet is going to have different ending balance for inventory because the cost of goods sold has been different for each of them. Yeah, makes sense? Okay, and then weighted average. So now we have like kind of a calculation we're going to have to do. And the calculation is going to be redone after every purchase transaction. Okay, so the journal entry for this purchase transaction is the same though. Okay, this same amount of inventory is being purchased, $1,460. So this journal entry is the exact same as it's always been. Now we're gonna buy 4 more. So we basically, what you can do is just count the total number of units. We started with 2. We're adding 4 more. We have 6 units total. You then start with the cost. $700 was the value of the original balance. Plus, I'm adding $14,060, right? So now my formula is this total cost divided by the number of units, 360. So this is, in one line, we're representing all of our inventory. We kind of did it backwards though, where we had the total cost and the number of units, and we just backed into the weighted average unit cost. Okay, so now we don't have to have the layers because now everything, all 6 of these units is represented by one weighted average cost. Okay, so now when we sell 4 units, it's very simple. 4 units, the weighted average cost is 360, and our cost of goods sold is just 4 times that, 14,400. So then we would basically do cost of goods sold, 14,400. And now how many units do we have left in inventory? We had 6, we sold 4, we have 2 left, same weighted average cost. Now we're buying 12 more. So again, the purchase transaction, that's when we have to trigger a recalculation of the weighted average cost because now we have a new cost basis, right? We have new inventory coming in at a different per unit cost. So we're gonna have to redo the calculation. So again, what you can do is just add up. We have 2 units. I'm adding 12 more, so I'll have 14 units. The total value is 720 plus, okay? And then I can figure out my unit cost is the total value divided by the number of units. So now it's like some weird number, 377 point something, okay? But I can use this as my value going forward for my sales transaction. So when I sell 10 units, it's just using this one weighted average. I don't have to do any go from the back or the front or anything. It's just using that one number. Okay. And then we'll have 4 units left. And again, we'll always have 4 units left because the physical movement of goods is the same. I'm using the same transactions for all these. The only difference is the costing method has changed. So 4 units. Here's my weighted average cost. This times this, 1508. Okay, so let's compare these 3. So, oops. So for FIFO, it was 15,020. For LIFO, it was 14,060. And for weighted average is 1508. So FIFO was the highest, LIFO was the lowest, and weighted average was somewhere in the middle. It did change, right? It changed from 360. First it was 350, the opening balance, then it changed to 360, and then it changed to 377. Yeah? And it only changes when you buy inventory, because that's when you have new inventory coming in at a different unit cost. Then you have to redo the calculation. The sales transactions, you just keep using that same weighted average, because all the units that you have in inventory is kind of valued at the same weighted average amount per unit. Okay, so that's a key thing to remember. Weighted average, you only recalculate it when you have a purchase transaction. Sales transactions, you just use the weighted average that you've already calculated. Okay, everyone clear on that? Yeah, well, we're going to find out because we're going to do a practice problem now.